Good morning. Happy February 1st. The auto industry had a rough and interesting month in January. Dealers are struggling, banks are struggling. Deals can be found, but it's still a little bit tricky. All that in mind, I am going to walk you through our January update. Let's jump right into it. And yes, very official here at CarEdge and CarEdge.com. We have a PowerPoint, folks. And if you like this style, let me know in the comments down below. This could be a monthly series that we do. The way this PowerPoint is broken out, red flags. These were things that happened in January for consumers that are bad. It means car prices are likely going to stay high and the environment to get car deals is going to be poor. Yellow things. Those are things that I'm watching. Those are things that I'm personally very interested in. And as they develop over the next couple of weeks and months, they could drastically impact the market for consumers and what your trade-in's worth, what that deal is you're going to get on that new car, that used car, etc. Green check marks. Tried to keep this as simple as possible. That's good stuff, guys. Those are tailwinds. Those are things that are helping us as consumers try and get good deals. Everything that you're about to see, this is through the lens of what is best for the consumer. I read a ton of automotive news, literally consume it all day, every day. It is my job. And everywhere I look, everything is angled towards, well, what's best for the dealers or for the banks or for the captive lenders. No, this is what is best for us if we had to go buy a car. We're going to start with what was bad, because that's what works well on YouTube. So we're going to start with the red flags. What was bad? We got GM's profits, their quarterly report yesterday, and their profits soared. And this is disappointing for a few reasons. The reason that the primary reason, the number one reason, is because GM's average transaction price has increased significantly. The average cost to purchase a GM last month was well over $50,000. And that's, of course, all of their different brands. But no matter how you slice it, they have figured out a way to constrain supply, whether that's a result of the chip shortage or not, increase the average transaction prices of their vehicles and make more money. That is a red flag for us as consumers. If Ford was able to do that, if Toyota was able, if all these automakers can find ways to restrict supply, get rid of their entry-level trims, and make more money, that is bad for us. That just means they're going to keep raising prices because we can afford $50,000 GM products. I don't know how people can do it, but they can. CarEdge.com/finance pops. You can go there and do what?
You can finance, refinance, save money, and it only takes seconds to do.
All right, go take a peek. Don't go to the dealer without getting a pre-approval. We're here to help. The other red flag. Banks have significantly increased their loan loss provisions. We had all sorts of financial institution earnings in the fourth quarter, and many of them had significant declines year over year in their originations. PNC, US Bank, Wells Fargo, Capital One also struggled as well. And we've seen, where is it here? Here it is. We literally got these earnings out today from Credit Acceptance Corporation. They have set aside so much money for loan loss provisions, and Credit Acceptance Corporation primarily lends to those in the subprime space, that their net income fell 42%. They attributed another 41 million, or they have a 41 million decline in profits as a result of just putting more money set aside for loan loss provisions. Why is that a red flag? You could make a case that it's a green check, like it's actually a tailwind. It's something that's going to help used car prices come down, because if there is an influx of repossessed vehicles, that should theoretically lead to more used car supply and drive down prices. I put it as a red flag because anytime we have millions of consumers so upside down on their car loans, and again, the leading indicator here are the banks setting aside more money for loan loss provisions and charge-offs, that's just bad. Like I don't quite understand or have a point of view yet on what the outcome is going to be there, but I think it's going to be not so good. And yeah, there we go. We looked at that just a second ago. Okay, things to watch. Things that I am watching as a result of what happened in January and over the remainder of the first quarter and into the future. Okay, interest rates. This is where, actually I took a screenshot of it. It's right here. It might be hard to see. Let me see if I can zoom in. Oops, it's so hard to do this in PowerPoint. I'll read it to you. In January, the average new car interest rate is 8.41%. And before you say, Zach, that seems too high, blah, blah, blah. 8.41%. That's from Cox Automotive. Okay. And the average term is over 69 months for a new car. The average interest rate on a used car loan, which bear in mind here, the term of that loan is 70 months, 70. 12.88% is the average APR on that loan. That is a yellow flag. Is the Fed going to continue to increase the Fed funds rate? Probably. Everyone's guessing anywhere between 50 and 75 bips at the next update. That means that we're going to continue to see rising interest rates on subsequent financial products like mortgages, auto loans, etc. And if that happens, it's going to take more and more people out of the market, which is something definitely to watch. It should also increase the likelihood that dealers want to negotiate because there's simply less demand. But just let that sink in for a moment, how significantly higher those interest rates are than where they were a year ago or even 6 months ago. And this is a friendly plug that at CarEdge.com, we partnered with credit unions to help you get financing through credit unions because credit unions have the best rates typically. Okay, another yellow circle here. Things that I'm watching. Wholesale used car prices appear to be stabilizing. This is a new storyline. This literally just came out in yesterday's Black Book market update. Early signs of a potential spring bump in the market are starting to emerge. So every time there's tax season, you typically see amongst older and cheaper vehicles that their prices appreciate for this period of time because the traditional pattern is, and go watch Car Questions Answered because this is Brandon's channel in a nutshell, because those cheaper vehicles, a lot of folks get their tax refunds and they go buy cars with them. That's typically what happens. That doesn't impact the $30,000, $40,000, $50,000 vehicle market as much as it does the sub $15,000 market. But we are starting to see here the older 8 to 16-year-old vehicles are reporting lower depreciation. Well, that is a direct correlation to dealers starting to build up inventory, of which there's very little good sub $20,000 inventory, but it's an indication that dealers are starting to build up inventory of those vehicles, valuing them more because they expect during this tax season that they're going to sell more vehicles. I'm watching that because it could mean that if you have like my sister just did this and her husband, they just bought a Mazda CX-5 and they got a great deal, very proud of them, but they traded in their 2011 Subaru Outback with 130,000 miles on it. They got way more than they got offered by Vroom or Carvana. It could be indication for people like them. Now's the time to sell your car. If your car is an older vehicle, maybe a little beat up, lots of miles on it, this is the period of time where on the wholesale market, those are actually being valued more because during tax return time, people are going to be buying them. So anyway, that's an interesting storyline and something to watch. Same thing here. Older used cars are holding their value better as well. Okay, now what are the good things? What are the tailwinds? What are helping us as consumers identify, patterns that are going to lead to better prices? New vehicle inventory continues to increase. This is a great sign. This is from all the way back on January 12th, but it's Cox Automotive. Inventory buildup suggests incentives may be coming. We are up to 1.8 million vehicles in inventory. In about 2 weeks, we'll have the latest data from Cox. I would not be surprised if it's near 1.8 million. Again, if it's ticked up a little bit, that's another good sign. Magnitudes of scale here. 1.8 million at the end of December compared to a revised 1.62 million at the end of November. Supply at the end of December was 715,000 units higher than a year ago. That is a good sign. Fleet sales. This is another great sign. Honestly, let me see. Where do I have it? Right here. U.S. light fleet sales are expected to rise. Light vehicle sales, where is it? Fleet deliveries, right here, folks. Fleet deliveries were forecast to rise 59% to 74% in January, so literally the month that just passed, according to TrueCar, JD Power, LMC Automotive. Why is that a good sign? Because if automakers are producing more vehicles for fleets, which are their lower profit margin vehicles, it means they have more capacity to build vehicles. If you remember, during the height of the chip shortage, the supply shortage, some automakers like Kia, for example, and Hyundai, they stopped making fleet vehicles altogether because they just wanted to make retail units because they're more profitable. Well, if we're seeing automakers start to, and a 60% year-over-year increase in fleet sales is a damn good indicator, we're starting to see them say, hey, we actually have the production to produce vehicles. That is a great sign because it means maybe we'll continue to see inventories increase. And if we see inventories increase even more, we'll see incentives increase even more. We had back here in the data, where is it? Here we go. Where were incentives? We're going to do it all together here. Incentives. Bear with me, folks. Here we go. Discounts also remained low, but continued to creep up for some automakers. TrueCar estimated January incentives averaged $1,441 per vehicle, down 20% from a year ago. However, these are up. No, they're down. They're still down. There was some chart somewhere that showed how incentives were up just a little bit month over month. So year over year, they're still down, but month over month, they are starting to come back just a touch. The brands actually, let's pull it up because that actually is very relevant. The brands that have the most significant incentives, Mercedes-Benz, Nissan, Stellantis, VW, some groups in here like Subaru, for example, you're not going to find any incentives there in the current market. And if new car inventory builds back up, that is a good sign for used vehicles as well, because it means, ideally, hopefully, used car prices should go down as more consumers are buying new cars that are at more price attainable or at more attainable price points. So that's your January update. That's what the heck is going on in the auto industry. Those are the things that are going poorly. Those are the things that I'm watching. And those are the things that are going well. Leave your comments down below. Let me know what you think. As always, go to CarEdge.com. Subscribe to the YouTube channel here. Regularly scheduled content with me and my dad back tomorrow. This is your monthly wrap from Zach Shefska at CarEdge. Thanks, guys.